Good afternoon, those who are online. Asayla, Prasanna, Sanjeev, can you all hear me?
Yes,
Good afternoon, sir. Yes.
Can you see the board?
Yes, I can see.
we can.
Uh, I think something wrong at either at my end or UI. You can see in කවුද කවින්ද මේ මට මෙහෙට ඇහෙන්නේ නැහැ ඔයගොල්ලෝ කියන දේ. මට ඇහෙන්නේ නැහැ. හරි. Asayla, I think you mentioned something, you and Sanjeev and Prasanna, three of you spoke something, but I didn't hear. I think even now you are telling something, Asayla. Your mic is on, as I can see.
I just switched it on now, but
Yeah, I can't hear it from this end. You? Yeah, Asayla. Fine. I am audible to you all, but I can't hear what you all say. Give me a minute. I have told them they'll come and fix it if there's anything to be adjusted. Can one of you speak something out loud to check whether I can hear you all? Asayla, Prasanna,
Yes, sir.
Sanjeev?
Yes, can hear you, sir. Hello.
are you able to hear us?
Yeah. Now you all are audible.
Okay.
Now you all are audible. We'll start. In the portfolio management, we have to do March 2023 question we are left with. And I have to give you an update on that March 2018 question. Sanjeev, is that right? March 2018, right?
Yes, sir.
March 2018. I have to give an update on that. And we started this financial statement analysis slide we started. So what I'll do is I'll quickly finish this slide. We haven't got any examples to do here. Because mostly the examples are dealt through the exam papers itself. So I will just quickly finish these slides to explain these slides to you and do the past paper question on the portfolio management, and then do the past paper on this financial statement analysis. Before doing that, in the March 2018 paper, Sanjeev, I think you mentioned that the suggested answer is different to the answer that I arrived here.
Yes.
When there was a minus correlation, it's perfectly negative correlation. I checked. I have got two books. In both of them, I don't find any other formula. Something similar to the formula which was given in the suggested answer. So I'm little. I'm little confused, and I checked with some of my friends as well. Whether is there any other formula that is supplemented when there is a negative correlation, perfectly negative correlation, and I didn't hear anything contrary. But I'm that is one thing I couldn't yet resolve. So according to the books I have, there no such other formula, because the standard portfolio risk formula is applied even when the correlation is perfectly negative. There's only one thing, that application of the covariance directly to the formula is one thing that I didn't touch, because in one of those questions, covariance was given. We use the covariance to derive the correlation coefficient, and based on that only we apply. So there is a way that we can use the correlation covariance directly in the formula, which I will explain when we do the March 2023 paper. And on that March 2018 paper suggested answer, I'll further check, and if I hear anything, I'll get back to you when we meet next time. I'll be looking forward for that. I'll be working on that continuously.
Maybe similar to that profitability index calculation also, there's a mismatch between the answer what we got and the answer script, right?
Yes.
So it should be either greater than 1 or less than 1, but as per the answer script, it is 16.9 or something like that. No? And also, sir, in October 2022, that exam paper, they have given, I think maybe right or wrong, that dividend growth model.
Yeah.
So they have mentioned like the dividend will grow at 5%, but but we have to deduct that from the required rate of return when we are calculating the price. But that also I feel like given as a wrong answer. So I'm not sure.
No, I think we will.
I'm not sure, sir, but just want to notify you. That's why I'm a bit confused and on with the answers. That's why. Yeah.
So the full respect, full regard is there for the suggested answer. There is no doubt about, no second word about it.
Okay, sir.
Yeah.
Okay, thanks.
So I'll explain this. I'll go ahead with this ratio analysis thing. So what we studied last week were the application of financial statement analysis. Financial statement analysis could be in three ways. First thing, trend analysis. This is something like the year-on-year vertical approach. So vertical analysis. Then we have common size analysis. This is something like horizontal analysis. In the particular year's financial statement, we have P&L, let's say 2023. This financial statement said we get into a base value. Let's say sales, we have a particular figure of sales, absolute number 1,234,859, let's say. So this figure we convert into 100 base value and see the corresponding significance of other line items as against this sales value based on 100. So thereby you convert everything in all absolute numbers into a base value of 100 against 100. Then it's easy to understand and easy to explain. So that is a common size analysis. When it comes to the balance sheet as well, balance sheet or the statement of financial position, you have assets. Under assets, you have non-current assets, you have current assets, you have total assets. So here the base value, let's say this figure is 18,934,255. So you get the base value as 100 here. As against this 100, what is the composition of non-current asset? Let's say non-current asset comprised of 11,258,135. So as against this, the significance of this, somewhere around 80% here. So the current asset, the rest, 18 to 19. So likewise, you going by a base value, you convert the rest of the numbers, the other components of the statement as against that base value. So it's a understandable and easy way to explain it. So that is common size analysis. Then we have ratio analysis. The ratio analysis is a establishing logical relationship between the variables of the financial statement. So there are financial statement in which you have different line items. So you establish logical relationships. So based on the logical relationship, we can identify 5 categories of ratios. Those are given in slide number 5. Profitability ratios, liquidity ratios, efficiency ratios, gearing ratio, market ratio. Right. So under which you have number of ratios. So all those ratios and the formulas are given in the subsequent slides. And the benefit of this ratio analysis. What are the advantages and disadvantages? This we discussed last week, right? What we have left with is the working capital management. So anything to be clarified on the points that we discussed? I think from this point onwards, we didn't discuss. We stopped at this point. We stopped at, I think, this point. So based on the ratio analysis, the different categories of ratios, profitability ratios, current liquidity ratios, efficiency ratios, gearing ratio, market ratio. Why we have categorized this? Depending on the area of focus. Now the profitability is to measure the ability of as against different measures. The liquidity is to measure the ability of the firm, ability of the organization to meet its current liabilities. There are current liabilities, creditors, bank overdraft. The company should be able to service them. When the bank overdraft is there, you know that it has to be regularized within the agreed number of days. 90 days, 6 months, 30 days. It has to be regular. Regularized means what? Money should come into this account. Either the customer have to bring his own money and put it in the account, or the customer has to process his production, process his operation, and ensure that the customers' funds, customers' receivables are credited to this account. When that happens, this account gets regularized. So that is how the settlement of the creditors comes in. Settlement of the liabilities, current liabilities come into play. So if you don't have adequate receivables, adequate current assets, you can't service these current liabilities, overdraft. So what are the current assets? Stocks, debtors, cash. So stocks must be there for the company to make use in its production. Then only the company can produce. Those products must be sold. When sold, the customers sometimes may purchase them on cash basis, sometimes may purchase them on credit basis. When they are purchased on the credit basis, the customers must be followed up closely to ensure that they pay the dues on time. If we have allowed them 30 days credit, we should, that on that basis only we have got the 30 days bank OD from the bank. So if the customers are delaying, then we are being pressurized from that bank's end through follow-up, through recoveries, through OD interest. So we have to make sure that our customers settle on time so that we can regularize our bank. So there has to be current assets. So that relationship, current asset versus current liabilities, are dealt under liquidity. So efficiency ratios. So number of days that we take to settle our creditors. Number of days that we take to get our customers recovered, to collect dues from our customers. The money due to us for what we have sold them. How far are we sticking into our credit policy of collection? How long do we hold on to stocks? There has to be a particular period within which the stocks must get rolled out for the production. And how long are we holding on to the product, on the finished products? So there is a time for which we can hold on to these products. So different businesses have different inventory periods, holding periods. For instance, the hardware can hold its products for a long time. But let's say vegetable or a fruit manufacturer, fruit processing company cannot hold on to their product for a long time. So there are different holding periods. More the holding period, depending on the business, more the risk the company will have to incur in terms of damages, perishable. If they are perishable, they might get perished. If they are obsolete, they might get obsolete. For instance, technology. Kind of. So that is the efficiency ratio. Gearing ratio is the relationship of long-term debt and equity. So the companies fund their business through debt capital and through equity capital. When a company is funded excessively through debt, high geared companies, we call them high gear companies. There are implications of it. When a company is low geared, that means the company's capital base comprised more through equity. Low amount of debt financing. When there is a low amount of debt financing, what is the implication? We don't get the optimum weighted average cost. So we understand usually the cost of equity, cost of preference shares are high, but cost of debt is relatively low. When majority of our fund base is through those high yielding sources, our overall capital cost is high in the company. Weighted average WACC is high. So we must have a right balance between debt and equity funding sources. So which is measured through gearing ratio. Market ratios are investors' perspective about the company. So how the potential investor would take a decision about the company, about the organization, is explained through market ratios. There are certain ratios like earning per share. So there are a number of shares in issue as far as the organization is concerned, and there is a profit attributable to the shareholders. So as against those number of shares, how much of profit is attributable to the ordinary shareholders. So when you divide that profit attributable to the ordinary shareholders through the number of shares in issue, you get the earning per share. Then the earning yield, that earning per share, the amount earned, rupees and cents earned per share. When you relate it to a market value of the share, you get the market yield, earning yield. Then you have the price earning multiple. Then you have dividend payout ratio. Then you have the dividend yield. So those ratios are market ratios. So all of those ratios and the formulas are given in the subsequent slides. Right? We will use them when we discuss the past tables. Right? Those online, anything to be clarified on the matters that I discussed so far? Sanjeev, Prasanna, Asela, Samira, Udari?
No, sir.
Okay. Now we have working capital management. What is working capital management? Working capital management is an analysis of the current assets and current liabilities. What comprised of current assets? Typically, current assets are comprised of inventory, debtors, or we call it account receivable, and cash equivalents. Current liabilities are comprised of usually creditors, accounts payable, and bank overdrafts. So what is the net working capital? Net working capital is the difference between these two. Net difference between these two is the working capital, net working capital of the company. What do you mean by that? So these current assets, inventory, debtors are funded through this. Right. So what will happen when we have excessive amount of, so this set is very excessive and this is very low. What will happen when this is high? Inventory, very high value. Debtors, very high value. Very high in the sense they are remaining, they are being held for a long time. Cash is very high value. Readily available, liquid cash is very high value. Whereas we don't have much pressure from the liability side. That scenario is called overcapitalized scenario. What do you mean by overcapitalized? We have invested a lot of our funds in the current assets. What does it mean? What are the implications of it? The implications are when we have high amount of inventory. I'm talking about the value. I'm talking about the value. I'm talking about the value, but I'm not talking about the period. What I'm trying to say is now certain items of high value items. So certain, let's say this organization is working with vehicle manufacturing or vehicle repair, vehicle maintenance and repairs. So some of the spare part items of the inventory might be of high value. Just because they are in isolation, those items are of high value, we don't say it is overcapitalized. What we essentially see is that the value is high because we are holding on to some inventory items beyond our requirement. So our inventory items are required only for 2 months or 1 month. But we are holding on to inventory for 3 months, 6 months. So eventually when the period is high, we are holding on to a large value of inventory. So that is the scenario I'm highlighting. Not going by the item value. Huh? Do you understand what I'm trying to tell you? Those online, did you get what I mean? සමහර item තියෙනවා ඒ item එක value එකෙන් වැඩි. දැන් මම මෙතන value එකෙන් මෙතන value එක වැඩි කියලා අදහස් කරන්නේ item එකේ වටිනාකම වැඩි නිසා මෙතන value එක වැඩි වීමක් නෙමෙයි. මම කතා කරන්නේ අවශ්‍ය ප්‍රමාණයට වඩා වැඩි වටිනාකමක තොග අපි ගාව තියෙන scenario එකක් ගැන. So and debtor balance is high, not because the individual invoice is of a high value, but because of debtors piled up without being properly following up and also allowing extensive credit periods. Right? We don't pursue our debtors. We don't insist our debtors to settle within a reasonable time frame. We just allow credit period to them excessively. So because of that, we are piling up on our debtor balance and we are holding on to unnecessary amount of cash. So that scenario is an overcapitalized scenario. What will happen in that scenario? So when it comes to inventory, our obsolences are high. That if we are holding on to this perishable and kind of technology sensitive items, the out of the technology scenario or damages or loss of inventory could be high because we are holding on to unnecessary amount of inventory beyond our requirement. Eventually after that time frame, these items will be obsolete, not relevant to the current technology, or they may be perished. We can't, and they may be slow moving. if a movement because of they have become slow moving inventory. So eventually we will have to write them off, which is a burden to the profitability of the organization. We don't follow up our debtors properly. So because of that, we are piling up on our debtors. What will happen? Bad debts. The debtors will disappear. Debtors will not be interested to settle. So we will have liquidity issues. Excessive cash. So idling cash being left idle means the opportunity to generate profit is lost. If you are holding on to cash unnecessarily, then the opportunity to earn some interest by placing those excessive money in a deposit, call deposit, 7-day overnight deposit is lost. So holding on to these items with unnecessary values and unnecessary periods is a scenario of overcapitalization. Are you clear on that? Those online, are you clear on that?
Yes, sir.
So overcapitalization I have given here. Overcapitalization is a situation where excessive investments are made on stocks, debtors, and cash with less creditors. Typical indication of the scenario is current ratio over 2:1. So yeah, this can be seen. So we mentioned here some ratios, right? This ratio, liquidity ratio. Liquidity ratio. So liquidity ratio is how much of current asset we have got as against our current liability. So since our current assets are high, we will be having a large value. The ratio is unnecessarily strong. When you really get into the items, there are losses arising out of them in future, potential losses. Right? So what will happen when we don't have adequate current assets, but we have excessive current liabilities? What is that scenario? That means we get inventory. We get inventory through, let's say, bank overdraft, and we sell. And we don't collect. We credit basis. Huh? Again, we get as inventory stock on credit, bank overdraft. We sell. We keep on selling. We keep on selling. But we don't follow up on our debtors. We don't leave adequate space for us to collect cash to settle these renewing overdrafts. We don't leave any space. One after the other, we use the overdraft and get inventory. We do sales. So what will happen? We will have a liquidity issue. So liabilities are excessive now. Now liabilities are piled up, whereas we don't have adequate current assets to support it. So that scenario is over-traded scenario. We call it over-trading. Trading. We trade overly. So when we trade, we should have adequate current assets to support it. What do you mean by that? We get OD, we buy stocks, and we sell it. So we should leave some space for us to ensure that the stocks we sold are collected or collectible within a reasonable period and within that, when we use our next OD, our collection will come and we should be probably settle our previous OD without allowing that previous OD to be added on to the current OD. Did you get what I mean? On the first point, this is the first point, we use our OD facility and we buy goods and we sell. But what we don't do, we don't collect. We don't collect cash. So this collection takes some time, let's say 30 days, 60 days, let's say 45 days, 45 days. So we should leave some space from this point. We should leave some space without availing the next OD. We are going for the second OD, use the OD and buy goods and sell. Again 45 days, collect 45 days. So what is happening? We don't collect cash, but we don't have stocks either. Why? We have sold them. So that's why this is low. We don't collect cash. The debtor balance is there, but the inventory balance is not there now. We don't have cash also. All what we have is a debtor. But from this side, we are piling up on creditors and OD. And we don't leave adequate space from this point to this point. So this is piling up. So our creditor balance, liability will be growing. So what we must essentially be doing, from this point to this point, we should leave some space until we collect this. Or we can possibly collect this. So let's say after 25 to 30 days, we have some signs of this being collected. So then you go and make available this OD facility. Then once this stock is sold after around 10-15 days, this is collected and this is settled. Now this is not the only, this is outstanding now. So we are not excessively pressurizing our current liabilities. Do you what I mean? Can you understand what I mean? So this is an over trading scenario. So under working capital management, the business, the management should not leave the organization to be over capitalized or over traded. What is required then? Maintain the right balance between the current assets and current liabilities, which can be seen through the liquidity ratio and also through efficiency ratios. With an efficiency ratios, efficiency ratios are inventory days. With an efficiency ratios are debtors period. With an efficiency ratios are creditors period. Inventory period is very debtors period is very creditors period is very වැඩි කියන අපි ගාව pile up වෙනවා creditors. Did you understand? So anything to be clarified on this, those who are online or those who are present here? Udari, Sanjeev, Prasanna, Asela, Samira.
No, sir.
Okay. So also in the meantime, this NPV calculation, which and the answer was also made available, right? Anything to be clarified on that? I'm just asking. If there any clarifications are, I will not take up in the middle of this. I will first do the past papers on this. I'll take up at, if at all, later only, right? Anything to be clarified there, first of all? Did you attempt? Did you give an attempt?
I attempted, but very difficult. I cross-check with the answers, but I'm not getting the same answers as what mentioned in the script. So very difficult.
Uh, Sanjeev, I am suggesting that we should solve this in the classroom.
Yes, sir. But if it was a bit like, I feel like that is more complicated. But if you can give us a like a glance view on this
Okay.
opportunity cost, it will be much more easier for us, sir.
Yeah. What
But
I'll do is then I'll do that.
okay,
Uh,
sir. Yeah.
I will take the points where the opportunity cost matter will arise in this sum, and I will take those points and explain the cash flow. That will do. Is it? But
Yes,
not
sir.
now.
That's good. Okay,
But
sir.
not now. I'll do it. Okay. So we'll do the past papers on this area now. Usually I have been starting from the March, September 2017. Uh, because of the time factor, I'll be not starting from March 2017. I'll be going reverse. I'll be going from 2023 March and backwards. Okay. Maybe we'll cover a couple of around 4 past papers uh, on this area. Did you take down this? Those who are online, did you take down or did you want? Do you think that I did specifically ask you to take this down? What I given is an explanation in the note. So this is a kind of a graphical explanation, kind of a easy way as far as for me to explain. That's how I used to do it. I'll redo this. Please have a note on. Please have this on your note. In red, I have written all overcapitalization scenario related stuff. In blue, I have written all over trading related conditions. Can I go from the beginning so that if you have missed any point, you can fill the working capital management as two aspects: current assets, current liabilities. Current assets has three items, usually, generally: inventory, debtors or accounts receivable, cash and cash equivalent. Current liabilities, usually we have creditors or accounts payable. Yeah, no, okay. Creditors or accounts payable, bank overdraft. Overcapitalization scenario will happen when we have excessive current assets. Relatively, we have low current liabilities. So this is low, downward arrow in red, upward arrow in red for current assets. So overcapitalization is what is written on in red here. So now under overcapitalized scenario, what are the implications on inventory? Risk of obsolescence, risk of damages and damages, out of technology situations. So usual risk of obsolescence, risk of damages, out of technology, or irrelevant to the market. Then debtors or account receivable, bad debts, the risk of bad debts. And the cash and cash equivalent lost the opportunity to earn profits. How? By putting in the fixed deposit, call deposit, money market deposit, etc. So these are low. So downward arrows. Creditors and accounts payable low, bank overdraft low. Then in blue, I have put downward arrow for current assets, upward arrow for current liabilities. Over trading. So implications of over trading when it comes to creditors and accounts payable and bank overdraft, excessive liabilities. No liquidity to settle. Why does it happen? Because inventory is low, downward arrow in blue, sold aggressively. So sales high turnover. In other words, from the P&L part, it's high turnover scenario. So from debtors and accounts payable, this will have some higher balance, not collected. Not collected. So cash and cash equivalent low. Again, downward arrow. No cash as debtors have not settled. So because of that, we don't have adequate liquidity to settle. So this is an easy way of understanding the over capitalization and over trading scenario. Those who online, anything I going to repeat? Those who online, anything I should repeat?
No, sir.
Okay, thanks. Sir. So we'll go to the past papers. March 2023, I will start with. Can I erase this now? Question number 2. The following information is available at Raytheon Private Limited for the years ended 31st December 2022 and 31st December 2021. December 2022, 31st December 2021, non-current assets, property, plant and equipment, current assets, inventory, trade and the receivable, cash and cash equivalent, current assets, total assets, equity, stated capital, revenue reserve, total equity attributable to the shareholders, debentures, 15% debentures, current liabilities, total equity and liabilities. Other information we have: net sales, cost of goods sold, profit before tax, profit after tax. Calculate suitable ratio for return attributable to the shareholders for 2 years and explain the possible reasons for difference between 2 years. Calculate a suitable ratio for return attributable to shareholder. Suitable ratio for return attributable to shareholder. So when we go into the five categories of ratios, where can we identify a suitable ratio? Investor, gearing, efficiency. Efficiency is about the number of days involved in turning around inventory, debtors, creditors, etc. Would that have anything to do with the return attributable to shareholders? No, that is out, completely out. Liquidity, current assets and current liabilities. That is also nothing to do here. So liquidity is also out. Gearing and leverage, the composition of debt and equity. Anything to do there? Composition of debt and equity. What percentage of debt out of the total capital or what percentage of equity out of the total capital? Anything to do there? Nothing to do there. Investor ratios. How a potential investor would see the company. What is the earning per share? Earning per share is the number of shares. You might think that is the ratio, but it is not, because we are talking about the number of shares there. Profit attributable to a share. Profit attributable to a share. Earning per share. So we are not talking about that either. Then we are talking something on profitability, because what the question is, the return attributable to return. Return is a profit attributable to shareholders for 2 years. So the ratio will come under profitability ratios. We'll go to the profitability ratios. So we have return on equity and return on capital employed. So return on equity is the ratio which gives the profit after tax divided by shareholder funds. So this is the ratio we have to use to decide the return on equity, return attributable to shareholders for 2 years. So question number 2, part 1. Return attributable to shareholder funds equals profit after tax divided by shareholder funds into 100. December 2022. 3,500. We have 38,000 for capital and revenue reserve. Both are shareholder funds into 100. 31st December 2021. The same ratio, profit after tax, shareholder funds into 100%. 2,500 divided by 19,000. 200. 9.2% here. %13.2% here. Those online, did you get these answers? So anything, any other different answer?
Same answer.
Thank you.
Same answer.
Now it is not yet solved. We have got this part. We have got the other section of the question. Don't forget that part. And explain the possible reasons for difference between 2 years. So in 2021 we have got 13.2. In 2022 we have got 9.2. It has reduced. Why is it reduced? To understand why it has reduced, we have to go to this. We have to go to the numbers involved in this. So 2,500, 3,500. It has increased. It has increased. Yeah, 1,000 by 1,000 it has increased. So around 50, nearly 50% it has increased. See what has happened here. 19 to 38. Doubled. Now from 19,000 to 38,000 or 90 million to 38 million or whatever. It has doubled. So what has doubled? Shareholder funds have doubled. What does it mean? Go to the numbers. Stated capital 13 million in 2021. Millions, right? These are, yeah, million. 13 million in 2021. 30 million in 2022. By 17 million, the stated capital has risen. Meaning new share issue has happened. So that new share issue has brought funds into the organization. But there had not been a corresponding increase in the profitability based on those funds introduced. So those funds would have probably been invested in assets. Let's see, this property, plant and equipment, see, out of 30, last year it was 35 million, now it has become 50 million. So by around 50 million it has increased. So probably these funds have gone into property, plant and equipment. So this property, plant and equipment will take some time to enter into the process and generate profits. So because of that long-term impact in 2022, just after the issuance of the new shares and the rising of the share capital, the profitability has not risen correspondingly. So that is the reason why it has dropped in this 2022 year. Are you clear on that? So that answer you must write as the reason for the drop in the ratio. So take down the answer. Sanjeev, Udari, Prasanna, Samira, Asela, did you get that idea? Any other different views on this?
No.
No, sir.
It could also be now.
Sorry, Asela?
we are looking at the balance sheet date, right? So the depending on at what point in time the capital was infused.
Yeah, depending on that what point the capital has infused, the time left for that
Yeah.
capital to generate profit would have a dependency.
Yeah.
True. What you suggest is true.
And the investment has mainly gone into capex, right? Property, plant, and equipment.
Yes, yes. That we can see through the number because 50 million, 35 million in 2021 has risen to 50 million in 2022. Increase of around 15 million. Saying that, that we can't. Yeah, probably that is the main point, main area to which the funds have the new capital has got invested or deployed. So we'll take down the answer. The lower return on equity in 2022 is mainly due to the infusion of capital for a sum of rupees 17 million. If you are worrying as to how has come, because 19 million, 38 million difference would not give 17 million. 17 million will give when you refer to the stated capital. Yeah, we'll take a full stop. This can be seen in the balances of a stated capital as at 31st December 2021 and 2022 respectively. Full stop and say, in response to this new capital, there had not been any substantial increase. In the profitability, to make a attractive return on equity in 2022. Full stop and say, further we can observe the new capital has been invested in property, plant and equipment in 2022. Next para, in sum, the possible reason for the lower within bracket 9.2%, the lower within bracket 9.2 return on equity is due to the increase in the shareholder funds without a corresponding and similar increase in the profit after tax. Without a similar increase in the profit after tax. In sum, I'll repeat the last para. If anyone has missed it, please take it down. In sum, the possible reason for the lower within bracket 9.2% return on equity is due to the increase in shareholder funds without a corresponding and similar increase in the profit after tax. Okay, let's move to the other next question. Part 2. Calculate the debt to equity ratio, debt to total asset ratio, and the interest coverage ratio, and explain the changes between 2 years. So you are asked to calculate 3 ratios. Debt to equity ratio, debt to equity. Under slide number 10, you have debt to equity ratio, debt divided by equity. In 2022, the amount of debt is 16 million. Equity is 38 million. In 2021, the debt is 14 million. Debentures, huh? Debenture capital is a debt capital. 15% debentures. You find just after the equity, 3% debt capital. Equity in 2021, 19 million into 100%. %. 74%. Those who are online, can I write at the bottom of my board? Can you see
Yes,
this?
sir.
Can
Yes.
you? Thank you. Debt to total assets. We call it as the debt ratio. What is the ratio? You go to your page 10, you have debt ratio, debt divided by total assets. In 2021, 14 million we have debt, 47 million we have assets. In 2022, we have 16 million debt, we have 75 million assets. %, in 2021. 30% in 2020. Sorry, 21% in 2022, 30% in 2021. Can I raise this? Have you all done up to this point? If not, I'll wait a couple of minutes to do the next one. The next one requires a small calculation. Sanjeev, Udari, Samir, Asela, Prasanna. Are you all done up to this point?
Still doing, sir.
Okay. Okay.
Yeah, okay, sir.
Okay. I'll wait a couple of minutes. Oh. So these ratios you will have to remember. These ratios will not be given in the formula sheet which is attached to your question paper, as we have seen last couple of years. Just to understand the relationship, to memorize or by heart the formula, the best approach is to understand the ratio, understand the relationship explained through the ratio heading. So which you will see when we do couple of past papers, you will see that logic. Debt to equity, debt to total asset. It's given in the question itself which factors to be used. So only kind of complication will come in kind of question that we are going to do now. Interest cover ratio and you will have some complication. We'll do that and you will understand. Sanjeev, can I proceed? Udari? Asele?
Yes,
Samira?
done.
Okay. Are you all good? Udari, Prasanna, Samir?
Yeah.
I assume yes, and I'll proceed. The next ratio, interest cover ratio. Interest cover ratio. So now the point is interest cover. Is our profit adequate, or how many times can we cover the interest through our profits? Interest cover. Interest will be covered through profits. So if you draw up the P&L, you will see revenue coming here, cost of sales here, then gross profit, then other income, then selling and distribution, then admin expenses, then you see the operating profit. After that only you find the finance cost or the interest cost. Then you get the profit before tax. So your point is, when it comes to this line, how many times can your profits cover the interest requirement? Is a point that we need to calculate here. So let's go to the ratio and see. Interest cover. Profit before interest tax divided by the interest charge. So profit before interest tax is given here. Profit before interest, here the interest, here only you get the tax. Profit before interest and taxes, here you get the interest, here you get the tax. So profit before this and this is somewhere here. So what we are talking about is the operating profit. Or in other words, profit before interest and tax, PBIT. Is it given in your paper? Is it given in your question? Yes, it is. Profit before tax is given. Profit before tax is given. So which point are you given? You are given only this point. What is the number there for 2022? 8,000, right? So now your question is finding this. To solve this equation, to solve this formula, you need to have this, which is not available. So you need to put the finance amount. In 2022, what is the finance cost? What is the interest charge? 15% debenture we have, 16 million, 15% debenture. So 1,600, 800, 2,400. 2,400. So 2,400, having deducted 2,400 only, we have got 8,000. So what is the possible figure here? 10,400 is a figure here. Do you see that? So when you write up the formula, profit before interest and tax divided by interest. So profit before interest and tax figure is 10,400. Now you know the interest charge as well, 2,400. So it is 4.3 times. In 2022, can you tell me the figures? You have 6,500 here. What is the amount of interest there? $14,000, 15,400, 2,100. Having deducted 2,100 only, we have got 6,500. So it is 8,600. So profit before interest and tax is 8,600. Interest figure is 2,100. $4.1 times. Those online, did you get that point? Asela, Prasanna, Sanjeev, Samira, Udari. Any clarification? Udari, I can't hear you, I think.
Can you hear me?
You're not audible. Sanjeev, any wrong from my end?
No, sir.
Okay, I can hear you. Okay. Okay, thanks. And explain the changes between 2 years. So we are supposed to explain the changes. So we kept calculating 3 ratios at a stretch. Now we'll have to keep explaining. Yeah, I'll leave a couple of minutes to come. So shall we take down the explanations? So we will explain one ratio after the other. So starting with debt to equity. So debt to equity ratio has dropped in 2022. So which was 74 in 2021 has dropped to 42% in 2022. What is the main reason? Is there any drop in the debt capital? No, it has in fact risen from 14 million to 60 million. It has risen, but the ratio has dropped. Why is it? Because the increase of the equity component is more dominant than the rising of debt, which has diluted the. Is this good or bad?
Good, no, sir.
It's quite good because earlier we were high geared company. We were exposed more towards debt without adequate capital. Now we have capitalized on par parallelly to debt. So this is somewhat good sign. So take down. In 2022, the debt to equity ratio has dropped to 42%. Due to the issuance of new shares for a sum of 17 million, despite the slight increase in debt capital. So why yeah, we'll take down further. In 2021, the company was a high geared company. Company was a high geared company with more debts in the capital structure. With more debts in the capital structure. Which has neutralized, which has overturned or neutralized or reversed or whatever. In 2022, with the share issue or with the rising of share capital. So next ratio we'll follow now, debt to total assets. Why in 2022 again this ratio has dropped 21%? Why is it mainly that debt? There's an increase in the debt, 14 million to 16 million. There's an increase in the debt, but even because of, despite that, in spite of that, the ratio has dropped. That is mainly because of the increase in the total capital, total assets. The total asset is because the increase in the total asset is because of the introduction of the new capital again. Right? Do you see that? The 47 million total asset has become 75 million. So there the new capital has made 30 million PP into 13 million property, plant and equipment to 30 million. Right. Along with that, I'll previous laws I thought I should tell that, but I avoided. So again, if you see the inventory balance, do you see a difference, significant difference from 4,000 to 12,000? 3 times it has increased. Do you think that has anything to do with this introduction of new capital? Rather no, because you go to the trade payables, there you see a corresponding increase. Not exactly, but 9,000 to 16,000. So new creditors has come.
But net sales have been reduced, no, sir?
Pardon?
Net sales have been reduced, no?
Net sales have reduced, yes. That I can't explain why is it depends on the number, but as far as this balance sheet is concerned, that probably you might think since the 47 million to 75 million increase, true that 35 million, 50 million it has increased by 50 million. Why is it not talking about this 12 to 25 million? Probably you might think. So that's what I mentioned. Yes, there is an increase in the inventories, but there is an increase in the trade payables as well. I could have explained it like this as well. I could have explained that cash and if the cash and cash equivalent has decreased significantly, I could have explained that the balance of the investment in inventory through the utilization of own cash. But I can't explain so because the cash and the cash equivalent balance has not dropped, rather increased. So if you are worried about why this total current asset has an increase, why is it not talking about it? That's the logic, because there is a corresponding increase in the payables. That's what I am always mostly I had been relating this capital infusion along with the property, plant and equipment. If that overrating situation is there, in fact, this should have the net sales should have given a rise. So as Sanjeev noted very correctly, but these numbers don't suggest so. So can we take down the total asset, debt to total asset? In 2022, the drop in debt to total asset ratio to 21. In 2022, the drop in the debt to total asset ratio to 21%. In 2022, the drop in debt to total asset ratio to 21% is again due to the increasing the total assets from rupees 47 million to from 47 million to 75 million in 2022. So third ratio, interest cover ratio, what sort of trend do you see there? It has increased 4.1 times to 4.3 times. Earlier, with our profit before interest and tax, we could cover 4.1 times interest. We could cover 4.1 times of interest. In 2022, we have been able to cover 4.3 times of interest with our profits. With our profit before interest. Is it a good sign or a bad sign? It's a good sign because our strength to service interest has improved. Why is that improved? Why has it improved? So 2,100 in 2021, the interest component has risen to 2,400. So if it has increased, if the interest component has, since the interest component has increased, ideally the ratio should have, number of times should have got lower, but it has not, it has rather increased. Why is it? Because the profit before interest and tax has increased. PBIT has increased in more aggressively than the interest in the rise of interest. So you see that reverse, right? Take down the interest cover ratio in 2022 has increased to 4.3 times. Has increased to 4.3 times from 4.1 times in 2021. Mainly due to the increase in the profit before interest and tax. You can continue from 8.6 million to 10.4 million. Profit before interest and tax from 8.6 million in 2021 to 10.4 million in 2022. You can continue and stop. So, 1 and 2 we have answered. Now, what you missed, I can dictate it and fill any gaps that you have left in your answer. So we'll move to part 3 of the question. briefly explain what is meant by gross working capital and the net working capital. So take down the answer. Gross working capital refers to gross working capital refers to gross working capital refers to the investment in inventories, debtors, and cash equivalent included in current assets. Full stop. Net working capital is the difference between the current assets and current liabilities full stop. In other words, the current assets are funded through current liabilities and the remaining portion financed through the company's own cash and cash equivalent represents the net working capital. අපි අර කලින් අර graph එකක් ගන්න ඒකේ first term current assets, second term current liabilities. So the difference between these two is the net working capital, and the gross working capital is the current asset, investment in inventory, debtors, and cash. So when the inventory of, let's say in this company, inventory of 12 million, debtors of 4 million, cash of 9 million, it is funded through payables of 16 million and other liabilities of 5. By 21 million, it is funded. So out of 25 million in current assets, 21 million is funded through the current liabilities and other liabilities. So 4 million is funded through its own cash, which is now gone out and replaced in terms of inventories and debtors. Right. So that is the idea. Are you all clear on that? Any those who online, anything I need to clarify further?
No, sir.
So the question is briefly explain what is meant by gross working capital and net working capital. This answer is sufficient. I think there are no numbers we are not supposed to be give. We are not supposed to give. We are asked to briefly explain. So I think it's a fair answer. So part 4 we will move. Briefly discuss how working capital affects both the liquidity and profitability of a business. I'll explain this a little. Briefly discuss how working capital affects both the liquidity. What is liquidity? The ability of assets, current assets, to be converted into cash without any major financial loss. So what are the current assets we have got? Inventories and debtors and cash. Cash and cash equivalent is readily convertible to cash without any major financial loss. So they are almost liquid cash. So only problem we have are with debtors and inventory, of which debtors are also a little more liquid than inventory, but below cash, because these debtors are supposed to repay us, and with even with a discount, offering some discount, we will be able to collect them. But that discount has not be a major one, which will cause to a major financial loss to the firm. Discount at the rupees 50 discount deal 50 discount deal anu so fair deal. So likewise. And the inventory is the most difficult part to be converted into cash. So that's why you would see a ratio in our slide number 8, quick asset ratio. When we check the quick asset ratio, we exclude stocks. That is to identify only the most liquid asset in the firm as against the current liabilities. Most liquid current assets of the firm as against the current liability. So that's why we exclude stocks in that ratio as well. So briefly discuss working capital effects, both the liquidity and profitability. So in terms of the liquidity, if let's say a major portion of the current assets are comprised of inventory, do you see that as a positive sign as far as the liquidity is concerned? It's rather unlikely. But if you see more debtors in the working capital, do you see that as a good sign? Yes. On the other hand, the current liability part, if you have more creditors, over trading scenario, more creditors, do you see that as a positive liquidity sign? No, we don't, because we have a lot more creditors than our current assets. In case if all of them turns up claiming their money, we haven't got adequate current assets to convert into cash and repay them. So we will have a liquidity issue there as well. So from two parts. From first part, if we have excessive inventories beyond our requirement, which cannot be converted into cash easily, we will have a liquidity issue. On the other hand, if we have high amount of creditors, then we will have a liquidity issue. Then we will move to the profitability side. So from profitability side, what is the profitability? The ability of the company to generate profits. What will determine the profitability? The availability of inventories to sell. Right? And the cost management. So if we don't have adequate working capital, let's say we are out of stock, will we be able to sell? No. we will not be able to say. On the other hand, let's say that is the point number one in terms of profitability. Point number two, let's say we have overcapitalized. We are overcapitalized. We have a lot of inventories, we have a lot of debtors, we have a lot of cash. Right? Is it a good sign for profitability? No. Why? Because we are not converting our inventories into sales. We are not converting our inventories into sales. When the inventories, when we capture a customer and sell only, that inventory will become a sale. So which we are not doing. So our sales are not increasing, as despite the high value of inventory we have, we are not converting it into sales. On the other hand, more and more we hold those stocks or inventories in our stores, the chances of them being obsolete and damaged will be high, which will have to be written off against the P&L. So again, the profitability is impacted. Right? So that is from the inventory part. On the other hand, cash, we are holding on to unnecessary amount of cash, anticipating expenses, anticipating creditor settlement. We are holding on to unnecessary cash. Is there any impact to the profitability? Yes. Why? Those cash left idling in the company will be losing the opportunity of earning some profits by way of interest through a deposit, or through funding the inventory and making more revenue, making more sales. If we have adequate cash, why don't we expand a little? Why don't we do another sale rather expecting the debtors to settle and refill our cash? Why don't we do another purchase of inventory and sell? So in that sense also, we are pressurizing our profitability. So holding on to unnecessary amount of cash is also not good, which will have a negative impact to the profitability. So those are the ways in which we will be pressurizing profitability by having unnecessary working capital in hand. So let's take down an answer. Anything to be clarified based on what I explained? Did you understand, or didn't you? I can explain once again. If you didn't understand any particular point, I can explain once again. So let's take down the answer. Working capital is the investment in current assets of the company which includes inventory, debtors, and cash. The impact of working capital into liquidity of a business can be identified under following scenarios. Bullet number 1, or the point number 1, or whatever. excessive amount of creditors under bullet 1 or point number 1, excessive amount of creditors and bank overdraft without adequate current assets within bracket ideally in debtors and cash equivalent, within bracket ideally in debtors and cash equivalent, would require not would result, not require, would result in a liquidity issue as or because the company don't have adequate cash or liquid assets to settle those due creditors and overdrafts on time. Bullet 2, allowing extensive credit periods to debtors or not aggressively following up debtors until settled would create a liquidity issue because company is not converting its liquid assets into cash. Company is not converting its liquid assets into cash on time to meet current obligations, on account of creditors and bank overdrafts. Next para, the manner in which working capital affects the profitability can be explained as follows.
The manner in which the working capital affects the profitability can be explained as follows. Under that, bullet number 1, holding on to inventory excessive than the requirement carry multiple implications such as the delay in converting inventory into sales, resulting a slower growth in revenue, comma, the expiry, obsolescences, and damages. Expiry, obsolescences, and damages of excessive inventory being required to be written off in the P&L. Being required to be written off in the P&L. Full stop. Bullet 2. Excessive debtors delays the collection of cash. Full stop. Not collecting the cash on time. Not collecting the cash on time and leaving them to stay as debtors would impact the profitability due to the
opportunity cost involved in those uncollected cash. Within bracket, in terms of investments returns, investment returns. So what I mean is that debtors, if they are collected, we have cash. Those cash we can either put into the inventory and purchase and sell and generate some profit, or we could have deposit in a fixed deposit or a placement and earn some interest. So leaving them as debtors will not making any cash to us, and we are losing that opportunity of creating some profits. So third bullet point, the debtors one is the second bullet, third bullet point. Excessive cash and cash equivalent means idling resources which again could be invested in short-term assets, short-term investments, and earn profits or interest. Okay, so this is the answer for part 4. So whenever this kind of question is there, so if you see the answers, the answer that we noted, it's in para form, yes, but it is not a essay. It's not a essay. We have given specific points for the examiner to evaluate and provide marks. So it is easy and very clear. And when you visualize yourself the areas to be addressed in the answer, if you can visualize comprehensively the areas to be addressed through the answer, then you can plot it in an organized manner and make your point very clear to the examiner for him to assess and evaluate. So rather, this is a very lengthy and kind of briefly discussed, but this is a brief explanation covering all points. We can't just simply say working capital will improve liquidity and profitability, kind of a simple 2-line, 3-line, or at least 4-line answer would not be sufficient to do justice to the question. So make sure that you write adequate length depending on the question and in an organized manner. So this is a model you can develop further on this, right? So we have done March 2023 paper. So it's 5:45 now. I will do that portfolio question what is left out in our previous discussion based on the same paper, and close that portfolio chapter matter, except for that Sanjeev's question last week. If I am able to find some resource to suggest that formula through any means, I'll get that conveyed to you, right? Except for that, once we do this,
we are closing this portfolio management part as well. Huh? Those who online, did you follow me?
Yes, sir.
Yes, sir.
Okay.
Yeah, okay, sir.
Okay. So we will move to question number 6 of the same paper. The following information extracted from one of the funds managed by investee fund management firm. So there are two shares, Skyrax and Comex. We'll call S and K. Expected return 12%, 22%, weight 0.7, 0.3, standard deviation 4%, 16%. Covariance between the two shares is 50. Calculate the portfolio expected return using the above data. So, question 6, part 1. So, portfolio expected return. Investment S and K. Return 12%, 22%. Weightage 0.7, 0.3. Expected return 12 into 0.7, 8.4. 22 into 0.7, 6.6. 15 is expected return. Right. Then portfolio variance, calculate the portfolio variance. So standard deviation comes with the square root of the variance. So variance is, without this square root, we can get the variance. So the same standard deviation formula, portfolio risk formula with the standard deviation will be this. With the square root will be the standard deviation. So without the square root, if you rewrite the portfolio risk formula, it is a variance. So we'll write the formula. Can you remember the formula? So which is usually given. So this formula has 3 parts. Huh? What is the first part? Investment of S. Then the investment of K. Standard deviation of S to the power of 2. Weightage of S to the power of 2. Then plus standard deviation of K to the power of 2. weightage of K to the power of 2. Or you can say, in other words, 1 minus weightage of S to the power of 2. This is also equals. Then 2 weightage of S, weightage of K, correlation coefficient of S and K, standard deviation of S, standard deviation of K. Right. So we'll substitute the detail. Standard deviation of S, 4 to the power of 2. Weightage of S, 0.7 to the power of 2. Plus. So last week we did, I think, January 2022. There, this is percentage now. I took point, I converted into decimal and two, which is little confusing. So in our model, when we started this session, we did a sum. In that also, we used the standard deviation as it is. 4%, we got 4. So we'll follow that basis, which is easy. So converting that into, because we get the same answer at the end. So the weightage, we get the absolute or the weightage as given in the Excel, as given in the question. So standard deviation of K, 16% to the power of 2. Weightage of K, 0.3 to the power of 2. Plus 2, weightage of S, 0.7, weightage of K, 0.3. Now this is the point I want to highlight. So what is covariance? Sorry, what is correlation coefficient? S and K. How do we solve correlation between S and K? Covariance of S and K divided by standard deviation of S into standard deviation of K. So we are given covariance as 50 here. So we can solve this, because we know this and we can know this. But what if we directly apply 50 here? This in fact I didn't follow, I didn't notice last week, but when I to answer to when Sanjeev's matter was being comprehended only, I realized this, why cannot we use this K? I comprehended, then only I thought I must explain this. So can we solve this for this to get covariance? So how do we do? Leave covariance here. S and K. This is the division. When you take into this side, it will be a multiplication. Standard deviation of S, standard deviation of K. Isn't this what is there down? Make a better. Make a money. So if we have this, we can directly apply it here, which could have been used in our January 2022 paper as well. 320 kilo covariance at the and take covariance apply කරන්න පුළුවන්. So which that point I didn't tell you at that when we were doing that sum. Instead I calculated this and brought, but not necessarily we can use the covariance directly into this formula, because the solving the correlation coefficient will give you, end of the day, this same thing we have in the variance of the standard deviation formula of portfolio risk, right? Are you clear on this point? Sanjeev, Udari, Asela, Samira, Prasanna, did you get that point, which I didn't highlight during my last paper?
Yes, sir. But we can calculate it separately also, no?
Yes, we can calculate this separately as well, but end of the day, it will be the same answer.
Yes.
My worry is that I didn't explain that to you last week. The relationship and the alternate way of using this, I didn't explain last week.
Yes, sir. Got it, sir.
Got it. So, 7.84 plus 23.0 plus 51.88%. Now, third, can I move third? Are you done with this? Those online, can I proceed to part 3?
Yes, sir.
Okay.
Yes, sir.
Calculate the portfolio standard deviation and explain the changes here. Standard deviation is the square root of this variance, meaning square root of this 51.88. %7.2%. Explain the changes in the standard deviation compared to individual standard deviation. So what are the individual standard deviations? Yes, it is 4%. K, it is 16%. So what is the weightage? 0.7, 0.3. Can you see the more weightage, more investment, more proportion of the wealth has gone into S with lower standard deviation. So the standard deviation of the portfolio has kind of concentrated or moved towards that low standard deviation area. Do you see that? So 7.3 is not close to 16, but rather close to 4. Why is it so? Because more weightage of the investment, more weightage of the wealth has gone into S. Those online, do you see this point? Sanjeev, Dari, Prasanna, Asela, Samir.
Yes, sir.
So can we take down that? Explain the changes in standard deviation compared to individual standard deviation. The portfolio comprised more weightage on shares of Skyrex within bracket 70% with a standard deviation of 4%. That said, full stop and say that said, only 30% of the only 30% of the wealth. That said, only 30% of the wealth has gone into COMEX with a higher standard deviation of 16%. Full stop. As the portfolio comprised more weight through Skyrex, as the portfolio comprised more weightage on the Skyrex, the portfolio risk has portfolio risk not has portfolio risk of 7.2% is more towards the risk of Skyrex. So that is the answer. Then part 4, briefly explain the concept of correlation coefficient with reference to portfolio management. Take down a small answer for this as well. Part 4, correlation coefficient explains the linear relationship of returns of two investments. Next para. In the case of investments with similar trends of returns, within bracket increasing or decreasing, under different periods or economic conditions,
comma, it suggests a positive correlation with the upward sloping curve, upward sloping line. And the coefficient explains the strength of the relationship between returns. And more closer returns to the line suggest a strong coefficient and wider returns suggest a weaker relationship. So have this graph underneath. Return of A, return of B, have a linear line like this, mark few points and say this is upward sloping, and from this point to this point, it is a strength coefficient. So next para have another next para have another para. So on the other hand, next para say on the other hand, for negative correlation, if the scenario where the returns move in opposite directions and presented
by a downward sloping linear line. Have this graph underneath.
So that part 4 is also done. So with this, the portfolio management is done. Again, we have done, I think, around 5 to 6 past papers there. Yeah. And ratio analysis, we have done 2023. We will do couple more. And we will move to the business valuation part. Last week, we will try to move to the business valuation part and leave. Last week, next week, we will try to move to the business valuation part, and I will make available the note for this. And we'll try to do that as well. So anything to be clarified those who are online? Prasanna, Asaila, Udari, Sanjeev.
Sir, can we look into that dividend growth model question also? That October 2022, if we have time.
Yeah, that's the only problem. There's no
Okay.
issue at all in doing that and giving an attempt to it. What is the
No.
question you mentioned? Well, let me see. What is the question you mentioned?
That first question, sir, they have like mentioned 5% growth, but when deducting that growth with that required rate of return, they have deducted only 4%.
First question. What is that? Paper now? Question number?
October 2022.
October.
Yes.
October 2020. Okay, this one.
Uh,
Question number 4 के तीन है?
yes, sir, I'm working on it.
Right. Question number 4 के तीन है?
Yes.
හරි මේක අපි කරලා නැහැ තාම මේ සංජීව මේක අපේ valuation එකේදී අපි මේ කරන්න තියෙන question එක.
Yes.
මේක valuation business valuation එක අපි next week පටන් ගමු ඒකේදී අපි මේ question එක කරමු.
Okay, so okay. I thought it is coming under dividend growth model, that's why.
No, mainly it is about valuation.
Okay, sir.
With expected valuation, this the expected valuation rated question. We do that there.
Okay, sir. Okay.
So with that, I will be winding up the session for the day, and we'll meet next week and do the rest. Thank you.